When the U.S. imposed tariffs on China, it aimed to pressure China into changing its trade practices. However, China responded strategically, not just with retaliatory tariffs, but by securing supply chains, tightening control over rare resources, and strengthening trade with U.S. rivals. This isn't just a short-term conflict. It's a long-term struggle for global economic dominance that could shape international trade and influence for decades to come. Trade conflict. In February 2025, the U.S. ignited fresh economic tensions by imposing tariffs on over $60 billion worth of Chinese goods. This move was not sudden. It was part of former President Donald Trump's long-standing goal to revive American manufacturing. The tariffs targeted crucial industries, including computer parts, electric vehicle materials, and other essential resources for modern technology. The aim was to pressure China into altering its trade policies and reduce its dominance in global supply chains. However, China saw the move as an attack on its economy and global standing. Instead of bowing to pressure, China executed a calculated response that extended far beyond simple trade retaliation. China's retaliation. China quickly announced tariffs on $35 billion worth of American goods, hitting industries such as agriculture, energy, and automobiles. But their strategy went further. Instead of just imposing tariffs, they specifically targeted industries linked to key political regions in the U.S., such as soybean production in the Midwest and oil exports from Texas. This approach aimed to create domestic pressure within the U.S. by making business leaders and politicians reconsider their stance on trade policy. Beyond tariffs, China also strengthened its trade relationships with other countries, including Brazil, Russia, and Mexico. By securing alternative suppliers, China reduced its dependence on American goods, effectively neutralizing the impact of U.S. tariffs over the long term. The rare earth advantage. China holds significant power in the global economy through its dominance over rare earth minerals, which are crucial for manufacturing products like smartphones, electric vehicles, and military equipment. The country supplies over 80% of the world's rare earth materials, making other nations, including the U.S., highly dependent on its exports. After the U.S. imposed new tariffs on Chinese goods, China hinted at restricting rare earth exports as a countermeasure. This strategy allowed China to exert economic pressure without direct confrontation. If access to these materials were limited, key industries in the U.S., such as technology and defense, could face major disruptions. This situation highlights the complex economic relationship between the two countries. While the U.S. seeks to reduce its reliance on Chinese goods, China's control over rare earths remains a powerful tool in trade negotiations. Any restrictions on these materials could force the U.S. to find alternative sources, but developing independent supply chains would take time and significant investment. Meanwhile, China's strategic advantage in this sector continues to shape global trade dynamics. China's energy strategy. Another key area of retaliation was energy. China was one of the biggest buyers of American oil and liquefied natural gas, LNG. In response to U.S. tariffs, China imposed new taxes on these imports, causing immediate financial losses for U.S. energy companies. Contracts were canceled, shipments delayed, and profits fell. At the same time, China expanded its energy partnerships with Russia and Middle Eastern countries. It also invested heavily in domestic energy production, reducing its reliance on U.S. imports. Even if trade tensions ease in the future, these new energy partnerships may remain, permanently reducing U.S. influence in the global energy market. The battle over technology. The real economic battle between the U.S. and China is not just about tariffs, it's about control over advanced technology. The U.S. has tried to block China's access to cutting-edge technology by restricting the sale of high-end computer chips and banning companies like Huawei from working with American firms. China responded by investing heavily in its own technology sector. Billions of dollars have been directed toward developing domestic chip production, artificial intelligence, and 5G networks. Instead of weakening China's technology industry, U.S. restrictions have accelerated China's push for self-sufficiency. Chinese tech companies are now producing competitive products that, in some cases, rival or surpass American alternatives. This shift is not just about trade. It's a race to lead the future of global innovation. And China is closing the gap rapidly. China's influence over U.S. debt. Another silent yet significant move by China was its decision to buy less U.S. government debt. China holds over $800 billion in U.S. Treasury bonds. And while selling all of it at once would harm China too, even small reductions in purchases can cause ripple effects in the global economy. By buying less U.S. debt, China made it more expensive for the U.S. government to borrow money, leading to higher interest rates for American consumers. This meant more expensive home loans, car loans, and credit card debt. It's a quiet form of economic pressure, but one that has long-term consequences, strengthening global partnerships. While the U.S. focused on imposing tariffs, China was busy strengthening its global trade network. It signed new trade agreements with the European Union, Southeast Asian nations, and key Latin American countries. The goal was to reduce reliance on the U.S. while expanding China's influence in global markets. For American businesses, this shift means more than just losing Chinese customers. It means facing tougher competition in international markets. As China deepens its economic ties with other nations, U.S. businesses may find it harder to compete globally. The shift in North America. While the U.S. and China dominated headlines, Canada and Mexico were also caught in the trade conflict. Both countries faced U.S. tariffs, leading them to impose their own retaliatory tariffs on American products. Canada targeted U.S. farm goods, while Mexico imposed tariffs on steel, pork, and whiskey. However, the most significant shift was how both countries strengthened their economic relationships with China. This trend could weaken America's influence in its own backyard, as China becomes a more attractive trade partner for Canada and Mexico. The reshaping of global supply chains. For decades, global supply chains have been heavily dependent on China. However, with rising tariffs and geopolitical tensions, many companies are rethinking their reliance on Chinese manufacturing. Anticipating this shift, China has been investing in alternative manufacturing hubs in Vietnam, Indonesia, and parts of Africa. This strategy not only helps China avoid future trade risks, but also strengthens its relationships with emerging economies. Meanwhile, American companies are facing higher costs and longer timelines to shift production elsewhere. The result is a permanent transformation in how goods are manufactured and distributed worldwide. The impact on American farmers. One of the hardest-hit sectors in this trade war is American agriculture. China was once a major buyer of U.S. soybeans, corn, and pork. However, after the tariffs, China reduced its purchases and turned to suppliers in Brazil and Argentina instead. This shift left American farmers with surplus crops, falling prices, and rising debts. While government bailouts provided temporary relief, the long-term concern is that once China secures alternative suppliers, it may not return to U.S. agriculture, even if tariffs are eventually lifted. Rising costs for American consumers. Trade wars don't just affect businesses, they impact everyday people. Higher tariffs have led to increased prices on a range of goods, from electronics to clothing to groceries. Many products now cost more simply because of added import taxes. For consumers, this acts as a hidden tax, raising living costs without them realizing the connection to trade tensions. Meanwhile, stock market volatility, caused by trade uncertainty, has impacted retirement funds and investments, adding another layer of economic instability. In conclusion, trade wars are easy to start but difficult to end. Even if the U.S. and China reach a new trade agreement, the damage to business relationships, supply chains, and trust has already been done. China has been actively working toward reducing its dependence on the U.S. by investing in its own industries, forming new alliances, and positioning itself as a global leader in technology and finance. The central question is no longer just about tariffs. It's about the future of global economic power. Is the U.S. strategy effective, or is China quietly gaining an edge? As these economic battles continue, one thing is clear. The trade war is reshaping the global economy in ways that will be felt for years to come. If you enjoyed this video, please subscribe to our channel. Your support is greatly appreciated. Thank you.